Ever wondered how the stock market works? Or maybe you've heard terms like stocks, bonds, and mutual funds thrown around and wondered what they actually mean. Well, you're about to find out. Imagine owning a piece of a company. That's essentially what a stock is. When you purchase a stock, you're buying a tiny fraction of a company. This makes you a shareholder, and as a shareholder, you're entitled to a portion of the company's earnings and assets. Stocks are a great way to grow wealth over time, but they also come with risks. The value of stocks can fluctuate dramatically, so investing in them requires a level of understanding and acceptance of potential losses. Now, what about bonds? Think of bonds like loans, but instead of you borrowing money from a bank, you're the one lending money. When a company or a government needs to raise money, they issue bonds. People buy these bonds, effectively lending them money. In return, the issuer of the bond promises to pay back the loan by a specific date, along with interest. Bonds are generally considered safer than stocks, but they also offer lower returns. Next on the list are mutual funds. A mutual fund is a pool of funds collected from many investors. This pool is then invested in a diversified portfolio of stocks, bonds, and other assets. The idea here is to spread out risk. You're not putting all your eggs in one basket. Instead, you're spreading your investment across a wide range of assets. Let's talk about IOUs now. IOU stands for I owe you. It's a document that acknowledges a debt. An IOU usually includes the amount owed, the date it should be paid back, and sometimes the interest rate. They're a bit like bonds, but less formal. Dividends. These are payments made by a corporation to its shareholders, usually in the form of cash or additional shares. Not all companies pay dividends. Those that do are typically well established and generate good profits. If you own stocks in a company that pays dividends, you'll receive a portion of the company's earnings on a regular basis. Finally, we have capital gains. This term refers to the increase in value of an investment or real estate. If you buy a stock at $10 and sell it for $15, your capital gain is $5. To summarize, stocks allow you to own a piece of a company and potentially share in its profits. Bonds are like loans where you're the lender, and mutual funds let you spread your risk across a range of investments. IOUs are informal debt acknowledgments, dividends are a share of a company's profits, and capital gains are the increase in value of your investments. Remember, investing can be a powerful tool for wealth creation, but it also comes with risks. Understanding these terms and how they work is the first step towards making informed and wise financial decisions. Whether it's stocks, bonds, mutual funds, or any other financial instrument, the key is to understand what you're investing in. And that's a wrap on the basics of the stock market and its key terms. It's a fascinating world, filled with opportunities and risks. But with knowledge and understanding, it's a world that can offer substantial rewards. This video was brought to you by Prosperity Pulse, your guide to financial freedom.